Mike Wilson, I'm not going to mince words. You've been a piñata for people that are like, I want to participate in a market, but I just don't get the exuberance out there. What's the Wilson meter look like right now on market exuberance? And don't narrow it down to the silliness of NVIDIA, but how effervescent, how exuberant is a market I want to be in, but I'm scared stiff?
Yeah, I mean, look, there's been some big winners and some big losers. It's been a stock picking environment, quite frankly, really for the last year and a half. And look, we had that major low that was made in October 22, one that we identified as a good opportunity. The one last fall we felt was close, but didn't quite get there. But of course, we had a huge rally. And what's happened, Tom, and I think this is a differentiating feature of our
Yeah.
view versus others, is we view the last 4 to 5 month rally as being driven more by very loose financial conditions, extreme liquidity, which is finding its way into the right parts of the market. And the parts of the market that are working are what we call high quality growth stocks.
Yep.
And some of those you've mentioned, and some of those are, but it's not just tech stocks. Some of the industrial space, which are
Yep.
benefiting from some of those heavy handed government programs, for example. Some of the consumer space is having a bounce back,
Right.
particularly consumer services. And then, of course, these companies that are being efficient. And that's really what's been working. And it's
Well,
been, so in other words, the market's been very good at identifying the winners. It's also been very good at identifying the
well,
losers.
well, Mike, I
For
mean, you
example,
mentioned efficiency and you mentioned operational efficiency. And for me, I need you to drill down a little bit more. What indicators are you looking for? Are we strictly talking operating margins here? I mean, how do you evaluate, those sectors you're referring to? Like which sectors are primed to perform well given, that focus on high quality growth, on operational efficiency, on the narrowing of that big divide between the haves and the have-nots?
yeah, it's not really by sector, Damien. It's more by company. It's really company specific.
Interesting.
And we've talked about that, meaning within sectors, there are companies that are being more efficient than their competitors. And we're seeing that. So that once again, it is, as you say, the haves and have-nots. So I don't think it's a sector call. It's a company call. It's a very stock specific call. So that's actually a really good environment for active managers who can take advantage of that.
So
And we're
then,
seeing, like I said, we're seeing it across multiple industries. It's not just one or two.
so then, Mike, is the key identifying those companies that are going to improve their operational efficiency or selecting those companies that have an advantage over their peers?
It's both. And one of those advantages is just sheer size. Having scale, having the ability to kind of manage your cost structure, being efficient with your labor and hiring. And that's a pure scale argument. Then, of course, there are companies who are using various technologies, not just AI, to make their existing businesses more efficient. There are some, what we've discovered is within AI,
Right.
ironically, the companies that are actually being the most efficient are tech companies. They're the ones who are actually able to reduce labor and headcount, particularly in coding. That's one area where it's been extremely efficient, back office, et cetera. So in many ways, AI is helping to keep the labor
Well,
market a little bit soft. We are seeing speculative activity pick up in a meaningful way. I would say the daily expiration options market is probably your single best example of that. We have a lot of people sort of, in the stock market is like prop bets,
yeah.
almost like DraftKings and things like that. That to me is, signs that exuberance is pretty high. Now that doesn't have to end in tears. Okay. Leverage isn't always bad, but, we have a situation where people are reaching for risk because, there's FOMO.
Yeah.
And that's where the pendulum is right now, Tom, and that's why we're probably a little bit more cautious than some of our peers. I think a lot of folks, all they've done is raise their price targets based on higher multiples, and we're not willing to do that because we don't see the justification for higher multiples, given that we have basically
Yep.
no earnings growth across the broader economy. A situation is still kind of a difficult operating environment, and so we're going to be very selective, and that's why we think it's you got to be a stock picker here. You can't just buy the index.